When we started the company, we had ambitions to be small, so we failed. In reality, as we were leaving a big firm, it was a group of us, 8 of us started the company together. We were in one office. The biggest asset we had was a basketball hoop that we played horse. When you start a new firm, you try to set up meetings, and a lot of people reject you. But slowly but surely, we were able to assemble quite a bit of business in a very short period of time. But no, obviously, we had no ambitions to be that large, nor did we ever think we had an opportunity to be that large. I think probably in 1988, the largest asset manager might have had $400 billion in assets anyway. So we've obviously seen huge appreciation in assets since then, and then importantly, we've seen consolidation in the industry. But I think if you go back to the genesis of the organization was we will never compete with our client. That's still one of our key tenets today. So we don't have a balance sheet. The entire balance sheet is just what we need for regulatory purposes and operating cash. But aside from that, we try to get rid of it all, either through investing in different businesses or dividending and share repurchases. And then 2 was the importance of risk management. So the whole foundation of the organization, and 25% of the people who started the company with me came from risk technology. So it was a very different organization back then. But our 2 key principles are still 2 key principles today.
So you mentioned the importance of risk management. A couple of years earlier, you had an experience with risk that was formative in your career at First Boston, where you were co-head of the fixed income unit. And due to some investments that you made that were mortgage related, your unit lost $100 million. And that ultimately, in some ways, led to your departure from First Boston. I wonder if you could just talk about that, how that shaped you as an executive, as a leader, as a person.
Well, I started First Boston in 1976. I was the first Freddie Mac bond trader. And so the mortgage market was just in its infancy. And then in 1982, we had the ability to put a PC on our trading desk. Before that, you had no ability to put a computer on a trading desk. And it was very clear to me that if we could have computing power on the trading desk, we were going to have the ability to dissect cash flows of mortgages. And it was that led in 1983 to the first, carving up a mortgage into different tranches, and so we created the first CMO. So we used a lot of in technology to design and create securities, but we never spent any time using what we were creating, having the technology to help us navigate the risk of what we were creating. And we were the most profitable component of First Boston in 83 and 84 and 85. And sure, when you started having those types of successes, the firm gave you more capital. We were taking bigger and bigger risks without the attended risk technology to navigate that risk. And with a balloon balance sheet, even dwarfed in 07 with what 07 turned out to be, but back then it was a lot. And in the second quarter of 1986, we lost $100 million. And it was pretty transformational. I never forgave myself to allow ourselves to be put in that position. But up until that point now, and I was at the firm for 10 years, and I always thought this firm was an incredible partnership of people. And when you started having a problem, you saw how the fragmentation of that partnership occurred, and the whole idea of partnership was not present during a crisis. And I said to myself, 30 days after we lost money in that quarter, even though we made 130 the first quarter and lost 100 of it in the second quarter, I I said I'm leaving. But it took me a year and a half because I never ever thought I was going to leave, but it took me a year and a half to try to determine what I wanted to do next. And so I sat there. I, was a key leader of the firm for a year and a half, but I was constantly focusing on what would be my next thing.
Was it because you felt, as you suggested, that you blamed yourself, or was it because of the response of the firm was disappointing to you?
Yeah, it was all the above. I mean, you don't leave because you're disappointed in yourself. You try to buckle down and do it yourself. So it was a combination. I was very annoyed at myself and my team, but more importantly, the behaviors of the firm there was no such thing as partnership. And that was what I said when we started the organization. Within months after starting the organization, about 14 people left First Boston with me over the course of the first few months, and a couple of people from Lehman, and that's the formation of the firm. And we wanted a partnership. That's what I'm saying. We started the organization with the idea that we're going to keep it small.
Right.
And I do believe, we do these, we spend a lot of time today on personnel development, and we do questionnaires with our 13,000 employees today. And one of the positives in our questionnaire is the employee still believes it has a small firm feel to it.
Well, let's talk about that, if I may. 2 or 3 years ago, I traveled out to San Francisco to interview John Stumpf at Wells, and was enormously impressed by him. It seemed like a very sincere, genuine guy who really believed in the culture that he was espousing at his bank, and if there was any sort of doubt or hesitation or cynicism or dishonesty in the 90 minutes that I spent with him, and subsequently he appeared at a Worth event, I didn't see it. So I've been struggling lately to reconcile my impression of him with what we now believe, what some say is a toxic culture at his bank. Without asking you, I know you probably don't want to get into that, but Blackrock is known for its culture. It's known for its client-oriented culture. Are there still moments where you look at something like what happened at Wells Fargo and you think, is there something I'm missing? Is there something that might come up that could have that kind of impact?
Well, paranoia is the key to anyone's success, and so I probably spend 30% of my time on culture. I don't run the firm day to day anymore. I spend a lot of time on strategy, and obviously I could interfere anytime I wish, but I try to give the team the time to navigate the firm on a day-to-day basis. But importantly, no, I too have spent many times with John Stumpf, deep respect for what he did and how he built it, and yet it is a surprise of what we are hearing now. And I haven't been able to reconcile it. I agree with you, because when you spent time with John, he was passionate about what he was saying. He fully believed in how he believes his firm is positioned, about its culture, and it's hard to reconcile that with this whole concept of that these behaviors may have existed since 2009 or beyond or before.
I agree.
Now, on the other hand, as he said it, we have 236,000 employees, and a few percent of those employees, 3 or 4% of those employees, had bad behaviors. 3 or 4% of the, I guess it was 2% of the employees, and that leads to 5,000 employees.
That's right.
So it's hard to reconcile it. But yes, do I worry every day about some aberrant behavior? And so my view about large banks, and I don't know about Wells specifically, but in most large banks that have been built through a succession of mergers, it's hard to create one culture. 2, in most cases, most firms who are based on large mergers have multiple technology platforms, because it costs billions of dollars of navigating platforms into one if you're that large. And most firms, and I think that was the failure of Citi, if you go back to Citi during its failures of risk management, it was a succession of mergers, and they had multiple technology platforms. So I don't know specifically about Wells, but they did the big Wachovia merger during the financial crisis. So I don't know how that was connected. I can speak about Blackrock, that when we did, because we did two of the largest mergers in asset management, which are obviously dwarfed by these big bank mergers, and I have to remind everybody, the asset management business really is one business. It's not multitudes of different businesses. But we were religious, and we are religious today. Everything has to be on one platform. Right. And when we tell everybody, if you want to have you're part of the business on a different platform, leave. And so everything is on one common risk management, technology, general ledger. And so all the pipes, and I look at when you have that, your pipes are a unifier. And so the people in our Melbourne office, or people in our Zurich office, or New York have the ability to see exactly the same platform. The whole setup is exactly the same. And I do believe that is a major, it becomes cultural. Right. When you have everyone believing in the sanctity of that information. And so obviously we're going to be as good as the sanctity of information that is inputted in, but this is a major component of who and what we are, and we believe in it. By having one pipe, it gives you a lot better ability to navigate culture too.
So let's talk about culture in the wealth management industry in the context of the new Department of Labor regulations. Moving folks from a suitability standard to a fiduciary one. Yeah. Can you talk about what you think the impact of that is going to be?
I think the DOL rule is to wealth management what Dodd-Frank was to banks. I think we don't understand how behaviors have to change, how severe behaviors have to change from a suitability to a fiduciary standard. Obviously, a fiduciary standard means you have to do everything in the interest of your client. Now, I would imagine your client always thought that, but under the suitability rule, obviously, you were required to invest whatever you thought was suitable, and that was, and so it was very hard for a financial advisor, a wealth manager, to get sued by their client.
Right.
Under the fiduciary rule, which states you have to do everything in the best interest of your client, is so, that statement in itself is so legally constrained that, unfortunately, it means, and it hasn't been obviously tested yet, but it means that your client could look back 3 years later and say, well, you put something in there that obviously did poorly. Well, why was that in my best interest?
Right.
And so
why was that suitable?
Yeah. So it's going to open up more lawsuits, which means it's going to change the behaviors of firms. So most importantly, let's talk about a Merrill Lynch or a Morgan Stanley or today, the financial advisor is either king or queen. They have the responsibility to navigate the portfolio of their clients. I believe when the DOL is fully enacted, 70–80% of all financial advisors will be front relationship people, but they're going to have very little in terms of portfolio management. Under the DOL rule, it's going to move more and more things to a CIO office in these very large firms. And you're going to have the CIO making those decisions about, depending on the needs of the client. So they're going to be, and what it means, and in all our conversations with all these firms, they're all trying to design models. And these models are going to be determining where the asset allocation goes, and what we believe it's going to lead to 20–30% of all, and maybe more, of most of these model-based investments are going to be in ETFs. So you're going to see $1 to $2 trillion of money moving out of active into passive.
So what happens to active management?
The good ones will do better because that means less money chasing those ideas. To me, this is a pendulum stuff. Right now, 90% of active management's underperformed so far in 2016, the worst year ever. That's also true in fixed income, too. I mean, one of the shocking statistics, now this is a week old, even in high yield right now, the high yield index is the 96th percentile. So only 4% of the high yield managers outperformed the index in 2016. Now, the reason why, a lot of people avoided, let's say, energy. Good reason in 15 and 14, but they did not get back in it. In the energy sector was in the index, and so most people underperformed. It's in the short run, it's going to be bad for those mediocre managers. Maybe long term for those mediocre managers who underperform. For the managers who have shown that they're able to navigate around the marketplace as well, whether it's a hedge fund or a wealth manager or an investment manager, they'll see flows. But what it does mean is we're all going to have to lower our fees too. There's going to be a huge compression in fees. This is, so we're doing, at Blackrock, we're doing an RFP right now. We do this every 5 years, all in terms of our custodial relationships. And without getting into details, because it has some big implications on some firms. What we have found in this most recent RFP, the fees are going to be, custodial fees are going to be down 30%. That's what I think the final.
Wow.
We're seeing the whole ecosystem fees shifting down. We announced a bunch of fee cuts. We're doing that because we believe we're doing it offensively to stay in front of it. But I do believe the DOL, but also just the whole nature of the business, you're going to see lower fees across the board, which is unquestionably better for our clients, right, and not as good for our industry.
So let's talk about kind of transformative roles. You and I spoke a few weeks ago for an interview that appears in this issue of Worth. And at the time, we were talking about your public role. Mm. And you said something to me that surprised me. I thought might surprise other people as well. You said, personally, I'm a very private person. But you've been taking a more public role on issues. And I wonder if you could talk about how you see your role when you decide to speak out, and if you enjoy that.
I still don't enjoy it.
Mm-hmm. Well, thank you again for being here today.
Well, I mean, this is evolutionary too. So for the first truly, let's say 20 years of BlackRock's existence, we really were mostly out of the news. We went public in '99, so it was just by the nature of being a public CEO, I had to, be more public. But only public to my shareholders, and obviously you're trying to attract more shareholders. But in that nature, I had to play a bigger external role by navigating a public company. But the financial crisis really opened up my eyes, and I think a lot of people's eyes, and certainly opened up, I think, society's eyes, that whether it was right or wrong, the asset management industry abdicated its responsibilities to navigate public opinion and also laws, working with governments, to the sell side. We paid the sell side huge fees in executing our stuff. They created stuff for us, and so they took the responsibility of law changes, of working with all the public sector organizations. It really was frowned upon by our institutional clients to be that public. They didn't want you to be public. And then we had the financial crisis, and we realized, maybe stupidly, that, well, the sell-side firms were really more out for their own balance sheet and less client needs. And there was a vacuum because they were in a big retreat, and their opinions were not, either did not want to be heard or were just people refused to hear their opinions for a long time. There was this incredible vacuum. So I remember in 2008 or 2009 going to Washington, and this was really the first time where I took an active role of trying to navigate things related to government. And I was asked, where have you been? Why haven't we seen anything from you?
And you said?
I said, well, I told them that story. I said, well, we'll be here now. And then more importantly, as we became, in 2009, the largest asset manager with the acquisition of BGI, then I think that developed more responsibilities for the firm. So I always felt then, as the largest asset manager with an absence of voice in the financial service area, there's a need for a voice. And so because of our scale and because of the need for voices, I took a different path by being a little more vocal. And then around that time, I guess in 2011, I guess, that's when I started writing these letters to CEOs about long-termism. And the real epiphany for me was related to our acquisition of BGI. If you go back to our legacy were a bunch of bond managers, and then we did the Merrill Lynch merger, and that gave us this whole international and global platform with more equity, more active equity, and then the BGI merger with iShares gave us a whole different position within the asset management business. But it was very clear to me that the majority of the assets from BGI were index funds. And it was very clear to me that, gosh, we have to own these companies forever. And it was very clear to me we own some really bad companies. Because you own an index. By nature, it's a bell-shaped curve. You have some good companies and bad companies. And it was very clear then, A, we can't ever sell these stocks as long as they remain in the index. And B, we have to be focused on long-term solutions. We cannot be influenced by an activist or some investor who's trying to shake up the company for a short-term event, but we're left with the remnants of a company thereafter. So we had to take a much more long-term view. And it was very clear to me at that time that our vote, our proxy vote, is the only power we have. And so it was very clear to me by 2011-12, we needed to be more active. We didn't have to be an activist, but we had to be a much more active participant in that dialogue. And it was through that led to even a bigger and larger voice. And then from the financial crisis, because we were the go-to firm worldwide during the financial crisis, and even till today, because we don't have a balance sheet, we don't compete with our clients, and our risk management, we're probably more engaged with governments than any financial services company in the world, even today. And that gave us even a bigger responsibility. So you add up the scale of the firm, the position that we were accorded, whether that's the Bear Stearns weekend, the AIG period of time, UBS's problems with Swiss National Bank, RBS's problems. We got engaged by Her Majesty's Treasury. All the Dutch banks, we got hired by the finance minister of the Netherlands. We are presently engaged in Greece right now. We're presently engaged at the ECB. Bank of England. I mean, we're still engaged. So it comes with a huge responsibility.
Well, so let's talk about that in the context of this small subject, the future of capitalism.
Yeah.
Obviously, and let's talk about this for a few minutes, and then I want to get to some questions. Obviously, we have a very important election coming up. Talk about the future of capitalism under President Clinton or President Trump.
Well, without getting into a guesstimate who's going to win, capitalism is being threatened right now. Or let me restate that. More democracies are being threatened.
By?
Democracies work when you have the majority of people feeling good about their future. Because it is a government of the people. It is not government for a small segment of the people. And what we have witnessed now in the last 20 years, whether it is in Japan or most of Europe and here in the United States, that large components of society have less hope. They have less hope. You know, you could argue they weren't as educated, and therefore they have not been able to cope with technology changes. We have had a bad policy of re-education as a country, and many companies have done a poor job in that. And so whether it is stagnation of wages, whether it is so many components of society now have children who, whether they got only a high school diploma or a college diploma, they're living back at home. And I tell everybody, I mean, I said, wouldn't you be pissed off if your kids came home? I mean, that'd create a lot of anger.
On both sides.
But unfortunately, we have that today, and it's only growing. And you could see how technology is going to be changing the workforce even more rapidly, whether it's AI, autonomous trucks and cars. We have 3 million males, mostly males, driving trucks. It is the #1 job of white males in America. And
That's a remarkable fact. I had not known that.
And so think about when we go to autonomous trucks, whether it's 2 years away, 5 years away, 7 years away. And so we're at a point now where technology is changing the workforce very rapidly. We have a point now where I believe since the financial crisis, governments have abdicated their responsibility of trying to re-engineer the economy, and we've been overly reliant on central bank behaviors. I think central banks are going to become considered, central bankers are going to be the goats of the future, because having rates over a short period of time, low or negative, can re-stimulate an economy, and more importantly, can help leverage balance sheets to restructure themselves. But over an 8-year period of time, now it looks like it'd be 9 or 10-year period of time, so low and negative interest rates. The most harmed component of society are the families that are living day to day, trying to save a little. Wealthy people are benefited by these behaviors because we own real estate and we own a lot of equities. Those who are living day to day have most of their money in bank deposits or bonds. And especially now in the era of defined contributions, where you have an unbelievable concentration of cash and bonds and not enough allocation towards the outcome, and that would lead to much more equity investing. So financial literacy, it's all showing up in this anger. And you see the anger and the lack of government in Spain now for 11 months with the Podemos party. You have the Italian election coming up in December 4th, but you have the rise of the Podemos party. And if Renzi loses this election in the 4th, he will step down, will create more instability in Italy. You have the elections in France coming up in April. You have German elections. You have Germany moving to the right. You have Brexit, which will probably lead to a very hard landing. All this is about anger. And then you have the Bernie Sanders, Donald Trump phenomenon here. I personally believe Hillary will win, but doesn't turn off. If she wins, the anger is still here. In fact, maybe the anger gets worse. And so if she's going to have a successful candidacy, a presidency, it means she's going to have to address this anger very rapidly, and that I believe it's through fiscal policy. And if Donald Trump wins, I believe the only way he's going to address it too is through fiscal policy for infrastructure. For good or for bad, in some ways, looking forward, it may be good. It's bad because of the conditions we live in, but we have $2 trillion of deferred maintenance. I mean, you know, Uganda may have better infrastructure than we do. they certainly probably have better airports today than we do here in New York. And so I believe we need to create a new agency.
An infrastructure bank.
Well, I don't want to call it a bank. I would almost call it like an agency or instrumentality. We need something that there's a public-private component to it. It should be about $1 trillion. I don't want to balloon the budget deficit, so you could probably have 80% financed by the private sector, but you need an agency of some sort to streamline permitting. I mean, the biggest problem we have is it takes years. We all know from the Tappan Zee Bridge nearby. It takes years and years and years. They're talking about, I read this weekend or Friday, that we finally may get enough money to build the new tunnels from New Jersey, train tunnels from New Jersey to New York. They started talking about that 5 years ago, and they will begin now, they said in 2019, and that may take 10 years to build. And
So probably 15.
I mean, it's just crazy, and so we need to create jobs through infrastructure. We need to find ways with 4.9% unemployment, if we had this big infrastructure spend, as I said, 80% private, 20% public, and even the public, you could spin it out into a REIT ultimately in a year or two. But more importantly, we need to find ways of creating jobs. With 4.9% unemployment, it'll probably create wage inflation, and it would probably change the mood